Hey there guys, first of all, before we start today, I just want to say a massive thank you to everyone who has been leaving likes on these videos. We've gone from about 20 likes per video to 30 likes per video, and now we're starting to beat 40 likes per video. It makes me a very happy man, and it shows me that people are out there and enjoying the content, which is great. It gives me the fuel to keep doing these episodes. So please keep that up. That will make me very happy. It's the best way to support the show. Today we're going to take a look at a company that in terms of volume of shares being traded every day, we're looking at 30 million shares traded a day. So they're a very popular stock. They have an 8.5% dividend yield right now. That's following the coronavirus crash, where all the dividend yields are looking that little bit more favourable right now. But 8.5% is pretty high, and so it is definitely a dividend stock. But is it a growth stock? And that's what this show is all about. It's a company whose share price is likely to go up over the next 5-10 years. In the last year, this stock has fallen 23%. The last 3 years, it's down 50%, and over the last 5 years, you'd find it's down 57%. So historically speaking, this has not been going well. The company we're going to look at today is ITV plc. Hey there guys, welcome then to episode number 14 of the FTSE show with me, Chris Chillingworth. Today we're going to take a look at ITV plc. Like I said in the intro, they seem to be more of a dividend stock rather than a growth stock. However, I wanted to take a look at the numbers and see how they fare up on this leaderboard. Historically speaking, they have not done very well in terms of share price growth over the last 5 years. Like I said at the beginning, down 57%, which is not what you want if you're holding on to a stock for 5 years. To be down 57% in value is not cool. But very interested, very, very popular stock, and I want to see how they do. So let's jump into the numbers. Okay, so let's take a look at ITV plc. FTSE 100 company in the media sector. So first of all, the first thing that strikes me is revenue is definitely growing, has been growing for quite some time now. Since 2009, we've had some steady growth every single year in terms of the revenue ITV have been able to bring in, which is great. Good stuff. So we go down to the expenses and have a look and see, well, what's been happening there. You can see, obviously, from a financial perspective, the expenses have been growing. What we're really interested in is the size of the expenses growth relative to the revenue coming in, because obviously, with most companies, when revenue is increasing, the cost of being able to capture that revenue is often going up as well, i.e. the expenses of running the business, the advertising costs, the staff costs, the marketing costs, all that kind of stuff. But what we want to make sure is that the costs of running the business are not growing at a faster rate than the revenue. Otherwise, there's going to be less profits coming through, right? In this situation, unfortunately, that is what's going on. Since 2015, we can see that expenses have actually been growing relative to the revenue. So, put it another way, the expenses cost them 71.7% in 2015. Then the expense of the revenue coming in, of the gross profit, I should say. And then in 2016, it cost them 72% of the gross profit. And then in 2017, that went up to 74%. In 2018, 78%. And then in 2019, the most recent report we've had, that expenses amount went up to 81.6% of the gross profit being spent on expenses. And it doesn't take a genius to see this steady trend upwards. We actually saw a decline at ITV from 2008 to 2014, which is great. That's exactly what we would be looking for. But it seems to have been going in the wrong direction now over the last 5 years. And that's a concern, because that's not just one bad year. That is 5 consistent years where the expenses of the business have been rising probably too high. And it's just going in the wrong direction. They've been rising faster than the revenue that's been going up. So that's the concern. We can look at depreciation. That's not an issue. That's only down at 2.2%, so we won't be too worried about that. We've got the operating profit there. Then we've got interest on debt. It looks like they've had quite high debt at some point before, between 2008 and 2014. and then they seem to be taking control of that now. We are seeing again growth here in the value of the interest being spent on debt relative to the operating profit. So here we've got the operating profit of the business, which unfortunately looks like it's going down. And then obviously because the interest on debt is going up, the percentages are going up. So there's not the trends that we're looking for. We're looking for the opposite of that, aren't we? We're looking for operating profit going up, and we're looking for interest on debt ideally going down or staying where it is. So both of those are going in the wrong direction, but it's not at a level that you'd be particularly worried about yet. So that is the only kind of bonus coming from that, is that it's not at a crucially terrible level at this stage, but the trend itself is a concern in terms of where the share price is going to be going in the future. Well, they did sell 62 million worth of assets which weren't part of the recurring everyday business in 2019, so that's going to add to the results slightly, but we've extracted that when we look at the true figures of what the everyday day-to-day recurring business of ITV is actually generating in terms of net earnings or profits. So it's already been extracted. So we want to come down then to the net earnings, and this is the biggest concern for me, and this ties into the fact that expenses are going up faster than the revenue, and as a result of that, profits are going down. And it's really simple stuff. It's just the expenses are going up quicker than the revenue are, and therefore this company are not going to be able to make growing profits. We can see here that the actual returns have been falling since 2015 onwards. So in 2015 was kind of like their peak. They made 20.4% return or profits, net earnings I should say, and then down to 20.1, 18.2, 14.3. Now as the recent year only 12.5%. So that is again 5 years of steady decline, or at least 4 years of steady decline here from the highs of 20.4%. And that's a concern. Of course it's a concern. When you're looking for growth stocks, again, if you're a dividend investor, maybe this isn't quite so much of a concern for you with the 8% dividend yield that ITV is currently offering. But if you're looking for a stock where the share price is likely to go up over the next 5 to 10 years, this is the exact opposite of what we would be looking for. We go down to the balance sheet. We can see that the current ratio, the assets against liabilities, is at a healthy level. It's nothing exciting, but it's at a healthy level, so nothing to be worrying about there. In terms of long-term debts, we can see that I would say that's pretty flat since 2016. The last 4 years, it's been sitting at about $1 billion in terms of debt outstanding, which sounds like a lot, but relative to their earnings power, it's okay. It would take them about 2.4 years to pay it all off with the profits that this company are making. And we go back up to the net earnings, we're looking at 415 million, right? So, I mean, obviously that is in decline, so that's a concern in terms of the debts being as high as $1 billion. And you can see here, you know, in 2016 it would have taken them, or 2015 it would have taken them a year to pay off their outstanding debts. Then 1.7 years, 2.2 years, 2.4 years. It's going in the wrong direction because the debts are sitting at 1 billion, but the net profits that the company are generating is going down. So their ability to pay off that debt is becoming more difficult every time. The shareholder equity has been down as well. It was as high as 1 billion and 1.1 billion in 2014, 2015. We've seen that fall to 750 million. It's back up to nearly 900 million now, but that's the concern, is that essentially there are less assets than liabilities, or more liabilities than assets than there were back in 2014 and 2015. So again, it's just everything's pointing in the wrong direction. Nothing's really flashing any warning signs or alarms right now as this is a company that are failing, but the trends are a concern, and it means that, you know, if we were to continue in this fashion, then ITV certainly would start flagging up some warning signs. We're looking at the reserves. The reserves aren't in a very healthy way, but they have moved in the right direction over the last 4 years. So they were sitting on 275 million in cash reserves back in 2015. Something obviously happened in the point where they spent all that and went into a deficit of 162 million. They've slowly been working away at that deficit, and they're now down to 1 million sitting in the reserves, which isn't very good. And obviously they've been in much better positions previously to that, so that's not good, and that scores against them, unfortunately, in that respect, because that's just not
something that instills much faith or confidence for me. And then the return on shareholder equity is quite good. So the return that the company are making off the back of the assets that they own is quite strong. So that's a very good score. Overall, first of all, I would not be invested in ITV plc personally. There are too many concerns here for me in terms of the trends that are all pointing in the wrong direction. We want positive trends, not negative trends, and there are some negative trends here, such as, and the most important one being, the expenses rising faster than the revenue that's rising and coming in. So as a result of that, the company are making less and less profits, falling from 605 million, 617 million, now down to 415 million, and we're back down to sort of the levels that we were quite some years ago. And I don't like this 5-year trend of things moving in the wrong direction. And then with the outstanding debt of 1 billion, it adds up to too much of a concern for me. They don't have any real money to speak of in their cash reserves saved for a rainy day. It seems to be that every time they save up a decent amount of money in there, they end up losing it or spending it on something, and they go back down into the deficit. So that's a concern for me as well. Let's take a quick look at the charts. Okay, so this is the period that we've been looking at in terms of the financials. As you can see, as we said at the beginning, the years going from 2008 up to about 2014, 2015 looked okay, didn't they? They looked all right. It looked like they're a company moving in the right direction, and then for some reason it's all started to turn around, and we've seen that in the share price, where the numbers are starting to fail, and we're starting to see these downward trends. We've seen a decline in the share price all the way from highs of £2.80 a share down to 93 pence a share now. Now, obviously, the coronavirus has given it that extra little bit of a hit, but we can see that well before the coronavirus crash that's happened in February 2020, at the time of recording this, the company were already on a very much downward trajectory for quite some period of time, for quite a few years. So, again, if you're a long-term investor and you're looking for a company that's going to grow and grow and grow, and you move from £1 a share to £10 a share, ITV are not showing that they are the company to do that.
Okay, so numbers not great, but not terrible. Kind of they've been doing all right in the past, but the last few years there's obviously that downward trend. It's not going in the right direction right now, and there is a definite, obvious trend of decline there, which is a shame. So it's time to get them up on the leaderboard then, see how they stack up against some of these other companies we've been looking at so far in the show. I've got their thing here somewhere already made. So we've got the black pen, which is a good start. I'm not expecting, well, they haven't done particularly well. ITV plc then have scored 39 points for the leaderboard, which puts them in the same position as ABF. They're joint 6th for right now on the leaderboard. Just going to chuck them on. Okay, so they're up on the board, joint 6th place. Not terrible, I mean, we've gone through 15 companies now. To be in the top 6 is pretty good. Not a company I would be investing in myself. I'm a growth investor. I'm looking for growth stocks. I'm looking for companies where the share price is likely to go up, from £3 a share to £30 a share over 5-10 years. That's the sort of thing that I'm looking for. I'm not a dividend investor. I can see the attraction to ITV plc as a dividend investor, especially with an 8.5% dividend yield. The returns that I get from my stock price growth, or the share price growth I should say, generally vastly outweighs 8.5%. And so whilst an 8.5% dividend yield is nice and easy, and it's a good strategy for someone who doesn't really want to work too hard to try and achieve a decent return, it's a decent approach. But for me, I'm looking for more than that. I'm looking for companies that are going to provide, I've got companies in my portfolio that have achieved over 1,000% over the last 10 years. So, that's the sort of company I'm looking for. But not a bad pick if you are a dividend investor. But yeah, there we go. ITV plc, 39 points. We'll see you next week. Cheers, guys. Before you go, guys, thank you so much for watching this episode. Hope you are enjoying the series. If you are, please remember to give this video a like and subscribe to the channel for more FTSE Show videos in the future. Thanks very much for watching, and I'll see you soon. Cheers.